In this video, we'll explore two multi-leg option strategies, condors and butterflies. Traders may choose these strategies to potentially profit when a stock stays within a specific price range while limiting risk. We'll break down how these strategies work and when they might be appropriate. We'll also discuss the potential benefits and risks, how to select appropriate strike prices, and the mechanics of placing these trades on TradeStation Pro. Condors and butterflies are option strategies where 4 options legs are traded simultaneously. All 4 options legs are the same type, calls or puts, and share the same expiration date. The only difference between them is the strike prices. You buy 1 out-of-the-money option, sell 2 at higher strike prices, and buy 1 further out-of-the-money option. This structure creates a risk profile resembling a bird with its wings spread out. The butterfly strategy is similar to the condor, but the 2 middle options have the same strike price. This risk profile has a shape that resembles a butterfly. Traders use condors and butterflies when they anticipate that the underlying security price will remain relatively stable before the options expire. These trades aim to profit from time and volatility decay, offering a potential profit even if the underlying price doesn't change significantly. This outlook can make condors and butterflies attractive options for traders in certain market conditions. Let's look at a call condor on the stock Baxter International Inc., BAX, which appeared in our radar screen scan for condors. BAX is trading sideways in the channel between $32.50 and $34.50. We can build and analyze this strategy using TradeStation Pro. We will choose options that expire in less than 30 days to take advantage of accelerated time decay. To build the upper leg, we will sell the 35 strike call out of the money and buy the 37 strike call deeper out of the money. We will sell the 32 call for the lower leg and buy the $30 call. This example highlights one of the condor's risks. Both short calls are at risk of assignment until expiration or when they are bought to close. The short 32 call is in the money and may have a higher risk of being assigned. However, purchasing the $30 call limits the maximum potential loss if that happens. We can analyze the call condor in TradeStation Pro. The maximum profit for this strategy is limited to the net premium collected and is realized if BAX's price is between the short strikes at the option's expiration. The call condor's maximum loss is $145. This is calculated by subtracting the premium received from the short calls from the difference in strikes between the long and short calls on one leg. This call condor has a $2 spread between the 32 and 30 strikes and between the 37 and 35 strikes. The 55-cent premium makes the maximum loss $1.45, which is $2 minus 55 cents. The maximum loss is realized if the price of BAX is above the long strike of $37 or below the long $30 strike at expiration. There are 2 break-even prices to identify. Downward, the break-even price is $31.45, the short 32 strike minus the premium collected, and the upward break-even price is $35.55. It is the short $35 strike plus the 55-cent premium. A similar condor could be created by using puts instead of calls. Selling the 35 and 32 strike puts and buying the 37 and 30 strike puts of the same expiration creates the put condor. The maximum profit is $92 if BAX's price is between $32 and $35 at the option's expiration. The maximum loss for the put condor is $108 if BAX trades below $30 or above $37 at expiration. The break-even prices are $31.08 and $35.92. While the assignment risk on the short puts remain, the maximum loss is smaller than the call condor. The put condor's lower risk and higher reward may make it more appealing. This could be one of several factors to consider when evaluating whether to trade a call or put condor. When trading options, there isn't always a clear-cut reason to prefer a call condor over a put condor or vice versa. The choice often depends on market conditions and the trader's outlook on a company or sector. Potential reasons why a trader might choose a call condor include market sentiment. A call condor might be preferred if the overall market or the specific underlying asset has a slightly bullish trend. If bearish, the put condor may be favored. Higher implied volatility or IV. The option with a higher IV might be more profitable due to higher premium collection. Dividend considerations. Call options are typically less affected by dividends because the stock price drop is often offset by the time value remaining in the option. Conversely, Options generally become more valuable as the stock price drops, making them more sensitive to dividend payments. This would affect the short positions. Liquidity. In some cases, call options might be more liquid than put options for a particular underlying asset. Should the puts be more liquid, they may be favored. It's important to note that put and call condors have similar risk-reward profiles when properly structured. The choice often depends on the specific market conditions and the trader's analysis. The butterfly strategy is similar to the condor, except the two short options have the same strike price. The maximum profit is only achievable if the underlying price is precisely at the short strike at expiration. Due to the lower probability of that happening, traders may elect to buy to close a butterfly spread by buying it back before the short options are assigned or expire. The result is a profit if they can buy the butterfly for less than the premium they collected. If the cost to buy to close the butterfly is more than the premium initially collected, the difference represents a realized loss. The butterfly has a higher maximum reward and lower maximum risk compared to a similar condor. The trade-off is that break-even prices are narrower, so the butterfly could become a losing position faster if the underlying price moves quickly. Looking at a put butterfly on Cisco systems, CSCO, the maximum reward is $128 and the maximum loss is $72. Compared to a Cisco put condor with the same midpoint, it has a maximum profit of $86 and a maximum risk of $114. While the butterfly's higher maximum reward and lower maximum loss may be enticing, the risk profile is steeper. This means the break-even prices are much closer, which may increase the probability of a loss, since a minor movement of the underlying price could turn the butterfly into a losing position. Traders should analyze the underlying security's price action and evaluate factors that affect option pricing, such as volatility, time, and option type. Condors and butterflies are credit spreads that may benefit from dropping option prices. Ideally, volatility and time decay play crucial roles in these strategies. Volatility is both good and bad for these strategies. Low volatility often accompanies calm markets, where stock prices are more likely to stay within the short strike price range, increasing the chances of profit. High volatility, however, can carry additional risk factors. It may cause the underlying price to move outside of the desired range, which could lead to losses. On the other hand, high volatility also means option prices are higher, which increase potential profits if the trade is established with proper timing and strike prices. Time decay, or theta, is usually positive for condors and butterfly trades. These strategies often benefit as time passes because options lose value as the expiration date gets closer. This effect helps the short positions more than it hurts the deeper out-of-the-money long positions. The impact of time decay increases as you get closer to expiration, accelerating in the month the option expires. The key is to balance volatility and time decay. You want enough time for your strategy to work, but not so much that you're exposed to the risk of unexpected price moves. Consider using shorter-term options in low volatility environments and longer-term options in higher volatility conditions to allow the market to settle. Remember, market conditions can change very quickly. Constantly monitor your trades and be ready to adjust if needed. Additionally, it would help if you practiced analyzing and trading condors and butterflies in TradeStation simulated mode. This lets you become familiar with the strategies, order entry, and position management without risking real money. With an understanding of condors and butterflies, you can add these powerful tools to your trading toolkit. These strategies offer unique ways to potentially profit in various market conditions, even when the stock, ETF, or index prices don't move much. They can help you manage risk and potentially profit from time decay. While they require careful planning and monitoring, mastering these techniques can open new opportunities in your trading. Start small and practice with paper trading first. As you gain confidence, these strategies may become valuable parts of your overall trading approach. With TradeStation's platform, you have the tools to execute these advanced trades. Why not explore how condors and butterflies could fit into your trading plan? Your next option spread trade might just be a few clicks away.